Hi, and welcome to this week's IMAX FinTech Market Insight. From now on, we've broken it into four parts. So this is part one, where we look back at last week's action. As usual, disclaimer: trading does involve the potential risk of loss of capital and is not suitable for everyone, although hopefully it is for you. Now, just be aware of leverage, because you can lose substantially more than that initial investment that you make. Everything that's included in these is just purely for educational purposes. We are not trying to encourage you to trade or invest. That has to be your decision. And before you make that decision, carefully consider the risks involved, your financial situation, your level of experience and risk appetite. And of course, you should only risk capital you're prepared, but more importantly, can afford to lose. If you've got any doubts whatsoever, seek independent financial advice before you risk your capital. Please, that last bit is so important. Until you understand trading, do not try and trade live. Practice, practice, practice with a demo. Okay, so again, another very active week, shall we say. So last week was another nervous week in the markets, with plenty of central bank action. The Fed and Bank of England both raised by 25 basis points. There was lots of other central banks as well, but I'm just focusing on those two for the moment. Powell was pretty uncommitted on the path forward, though, except to emphasise inflation is still too high and it's still sticky. I must admit, though, he probably enjoyed the fact that, inflation was less of a topic at the press conference, with the focus still on the recent banking crisis. Now, interesting, the dot plot, the further you go out, the wider the ranges between the dots. Just between the highest and the lowest levels of expectations from the members. And we'll see that on the next slide. But before we move on, the banks remained in focus. UBS finally agreed to buy Credit Suisse. Probably overall a good deal for them. They got parts of one of their major competitors. And of course, they managed to negotiate for potential losses, or at least some of them, to be underwritten by the central banks. Then on Friday, Deutsche Bank seemed to be the next target. There was questions surrounding sort of their stability. And that will be an interesting thing for the week coming forward as well. Something I did notice was Bitcoin broke out, and this seemed to be where maybe people were looking to exit banks, and maybe crypto, or Bitcoin certainly, has become the digital gold for the moment. Now, the big question for last week continues to be, what is the priority, financial stability or price stability? And I would say the latter is the winner. It is still about that price stability. Of course, central banks aren't going to let all the banks drop, or confidence in the financial system disappear any more than it has so far. But what was quite interesting was, at the FOMC meeting, Yellen was speaking at the same time, and the markets sort of more reacted to what she was saying at times than what Powell was saying, because she was discussing whether or not the FDIC deposit insurance scheme was going to be expanded, and she was saying that that's not being considered yet. So what was clear for the Fed, they seem unsure about where the economy is heading and when. And that seems to be increasing the chances of a recession, a hard landing. Doesn't it keep changing? Last year, yeah, recession. This year, earlier, in the first couple of months, well, probably we're going to miss one, with China reopening, etc., etc. And then all of a sudden, banking crisis hits. Okay, it's sort of fairly isolated, but it's around, and it is sort of making investors certainly nervous of the markets. And it's going to be an interesting week just to see what happens with Deutsche Bank if there is a big push on that one. Bank of England, they just, you've got to expect further hikes for them because inflation increased to 10.4. So, still got double-digit inflation in the UK where I'm based. In the Eurozone, PMI jumped to 54.1. Mainly on services, but again, that is going to be a further concern for the ECB, and of course they're going to keep an eye on that along with the rest of the data that comes out before their next meeting. Canadian inflation increased less than expected, only 0.4% month on month. That meant CPI is falling, and it dropped from 5.9% to 5.2%. But again, you just got to sort of look at what's causing that, and that was helped by the lower gasoline prices. So here's the dot plot. So this is the voting members where their expectations are for the coming few weeks or well, years actually, but where they see rates need to be to sort of get back to where they want to with the economy. Now I've added two because they're only every quarter now. So what I've added in is December of last year, which is on the left, and then I've added the one that was this week, and so you can sort of compare the two. Now, there's not really that much difference between them, but as I say, if you look at 2025, look at that. I mean, you've got one dot so high, and then all spread out coming down in that for 2025, and then further term, longer term rates looking lower. I'm just not so sure about that. Low rates are for emergencies, for a crisis. Okay, we see bits and pieces of them, and there's always another crisis around the corner. But shouldn't we have these types of level of rates, just to sort of control people's borrowings, rather than taking them down low, everyone sort of borrows to the hilt, then they go up and people can't afford it. So, I think personally it's better around these levels. And if the banks were forced to actually give a decent rate of return for leaving the money on deposit, I'm sure people would be happy to actually park some money with the banks as well. So, okay, that's it for this very first part. Now, if you are interested, we're going to move on to part two, which is what's coming out next week.